Hello, my friends. Brett Pattison coming at you today from the financial capital of the West, joined by the chairman,
Hello.
Brian Hunsaker.
How you doing?
Looking sharp as always, my
Yeah,
friend.
you too.
Great to be with you today to discuss something that we really can't believe we've never discussed in full in this podcast. As we were talking about what we wanted to discuss, we thought, have we ever talked about this important philosophy, we'll call it, or process, and we haven't.
We haven't focused on it. We've talked about a lot of the
Principles.
the principles in other podcasts, but I don't think we've actually talked about this specific thing.
No, we haven't. And we're not talking inflation today, my friends. And we're not talking the rebound in the market and whether the market has bottomed or not, because our answer will always be, we don't know. So we're going to talk about the process of how we invest and 4 criteria that make a great investment. And before we do, we'll talk about, we'll just mention how most firms like ours invest for clients. Most firms, number one, they invest overnight. You give them, $1 million and the next day you got $1 million in the market. And that's not how we invest our clients' money, which we'll talk about. That's how most people do. And most firms would put you in mutual funds or ETFs or a mix of some sort of model, invest you, and then they'd go off and they'd try to find the next client. I think it's pretty safe to say that we focus more on making our clients money and serving our current clients than looking for new ones.
Right.
which is a lot of work, right? And we love it. But the philosophy that in how we invest, there's 4 principles. And one of those will be when we put the money to work. But the first principle I want to talk about, and I'll mention it, and then you describe it.
Let me interject here.
Yeah, feel free.
The reason when I started the firm 22 years ago, almost 23 years ago, actually.
In this very office.
Yes.
The
Yeah.
financial capital of the West.
Yeah. I wanted to start a company that if I were the customer, I would want my advisor to use this approach, to do this approach. So we've often said that we eat our own cooking, and so this is the approach that we believe in. This is the approach that I believe in. If I were not the advisor, but the customer on the other side of the table, this is how I'd want my money managed. Yeah. And we do this we follow the same approach with our own money.
Okay, so you mentioned 23 years ago. Where did the approach come from?
So the approach came from backtrack or reverse about 7 or 8 years prior to that.
30 years ago.
Pretty close to 30 years ago. I was handed from another advisor in the office. I was working as a broker at a brokerage firm, Piper Jaffray. Another advisor in the office handed me a Berkshire Hathaway annual report and said, "Have you read Warren Buffett's letter to shareholders?" And I said, "No." And he says, "You ought to read it." And I did, and I was relatively...
Can I interject something?
Yeah.
Prior to receiving that letter to shareholders from Buffett, you were trying the CanSlim method, if memory serves me
That's
correct.
exactly right.
And many methods before that.
William O'Neill, CanSlim, and
IBD.
Investor Business Daily.
Yeah.
Yep, I was doing that. So I was relatively new in the business. I started in 1989. I'd been in the business 2 or 3 years, and I was looking for an approach that would consistently make money for my clients. And up until that time, I tried this. Like, well, that's all right. I'm going to try this. That's okay.
Yeah.
I started out the firm I was working for. At that time, when I first started, it was a company called Betcher & Company out of Denver, and actually that company has merged several times and now part of Wells Fargo Advisors,
which love their mutual funds.
Yeah. In fact, like you said, most advisors in our industry don't actually manage money. They actually farm that process out to other money managers.
Exactly right.
And so I just like this approach. And when I read Buffett, it just made so much sense to me, and logical and rational, and something that people can do. It takes a lot of time and effort. But that's what I like doing. I like that time. I like doing, spending the time and effort identifying great businesses, great investment opportunities. That's what I enjoy doing. And so that's why we do it this way, is because it's something that we believe in, and it makes a lot of sense to us.
Guess who else tried the canceling method?
You?
Me.
Yeah.
And you look for the little cup and handle of certain stocks, and as soon as it broke the cup lid resistance, you buy.
Guess who else tried that?
Who?
Buffett.
Buffett did,
yeah,
really?
Early on.
I didn't know that.
Yeah, he did technical analysis.
He was looking for his cup of Java, huh?
Yep, until he met Benjamin Graham at Columbia University. That changed his way of investing. And then Charlie Munger later on had a big influence on him, going from cigar butt investing, where you buy crappy companies, but they're so cheap, they're pretty good investments.
Yeah.
You get one puff and then you toss it. And now Buffett is buying high quality businesses that have long runways of growth and compounding their earnings and profitability, intrinsic value over a long period of time. That's the approach that he uses now.
Yep.
And that's what we do.
Yep. So let's go through these four and talk about what this process entails and the four principles. And the first one, Brian, is that we must understand the business and the industry. Explain what that means to me.
And just so we're clear, these are the principles that Buffett talked about in his letter to shareholders. And at that time when I read that first letter, I went and read everything I could on Buffett. I read every one of his letters to shareholders going back to 1977, and read every one of those letters since. But I just thought that this process was so logical and so rational, and it just made a lot of sense. But so the first one is, don't invest in anything you don't understand. You need to understand. If you don't understand it, then you walk away. And to me, that's just so logical. If you invest in something you don't understand, that's a sure way to lose money, in my opinion. And so
like, what would be an example of something that you don't understand that you've walked away from in the...
Are you thinking the same thing I'm thinking?
I'm thinking of a few things, so I don't know where you're going. But what's something you've walked away from because you don't understand?
Well, it's Bitcoin. I mean,
Bitcoin,
that's the one that just comes right to mind right now because it's so popular. At least it's in the news every single day. I still can't understand how you value Bitcoin, and that's part of the process. Part of our process we'll get onto later is, do you understand have you valued the business? Is it selling below intrinsic value? And I can't put a value on Bitcoin. I don't think anybody can. But then on the other hand, I don't understand why people are, think that Bitcoin is has value to it.
You know what the hardest one for me to understand, probably the hardest industry for me to understand, is biotechnology.
Yeah.
I mean, people will, and not so much anymore, but a while ago when I was, especially when I was in the education world, they'd come up and they'd say, well, it's looking for FDA approval on this drug, and if it gets it, it's going to go big. And I'm saying, well, what's the drug? What does it do? I don't get it. So I'm going to stay away from it.
Exactly. One of the things that it's important, this process of understanding, everybody has certain areas where they have expertise or maybe more knowledge than someone else, the next guy down the road. And it's important to understand where you have maybe a higher level of competence, higher level of understanding, and then we call it the circle of competence. If you understand where your circle of competence is, the areas that you understand, businesses, industries, and then it's important to stay inside of that circle. When you get outside of your circle of competence, that's where you get in trouble.
So here's the thing too with what we're talking about. If you invest in something you don't understand, your risk on that investment goes up dramatically. And so all four of the things that we're going to talk about, including understanding what the heck you're investing in, is a risk reduction. I guess that's the underlying
right.
Part of the method is it reduces risk.
All of these four principles taken together, each one of them reduces the probability of permanent loss of capital, losing money.
Great way to say it.
And that's in essence what we're trying to do, is put the odds in our favor of success.
You know what I'm really trying to understand right now, Brian?
What's that?
The metaverse.
Yeah.
I mean, you go out, and I don't want to get on a tangent, but you go out into an alternate world, and you buy a pair of Nikes and some Nordstrom clothes to be on an avatar,
right?
To go out into the world. Anyway, so you got to study and you study and you study and you research, and that's why it's hard, and that's why it takes time, and that's why most advisors don't do it. Okay, we'll get there with the metaverse. Two, here's the second thing. That company needs to offer a long-term competitive advantage. What does that mean?
And I always like to flip this and think about, what if you invested in a company or a business that didn't have a competitive advantage? Would you think that's a good idea? And I don't think that's a good idea.
Yeah.
Ideally, you want to invest in a business that has when we say durable, we're talking about long-lasting, look into the future. Does this business, in your estimation, and hopefully you have an understanding of that business, does it have durable competitive advantages against everybody else? And if it does, then that's something we're interested in. One of the things, in fact, I'm looking at Katie, but just behind Katie we have a shelf and of food. We have some food over there. It's kind of some snacks.
Some office treats.
Office treats and snacks. And Katie, thank you for keeping us well fed here. But there's Coca-Cola there on the shelf, Diet Coke. And I like to use that example as an example of a company that has competitive advantage. Why? Well, if you think about a company with no brand, what is their competitive advantage? Coke's competitive advantage.
Yeah, what is it?
It's their brand. It's the name.
Yeah.
Anybody can put pretty much the same ingredients inside a can and say Brian's Coke, Brian's Diet Coke. And that's Brian's Diet Coke is not going to sell. Diet Coke, and you put that right next to it, and you can charge 10 times as much as Brian's Diet Coke. And that's the one that has the brand that people love and know and trust is going to outsell Brian's Diet Coke.
Yeah,
time and time again.
This is probably the question, because we understand a lot of industries and a lot of businesses. This is probably the question that we spend the most time on for a company to make our list. Do they have a competitive advantage? Like Amazon, clear competitive advantage. Apple, right? The clear Coke.
When I bring an idea to Brett, that's the first question he asks me. If it's not obvious, what's their competitive advantage?
Yep.
We have an investment committee, and we throw ideas at each other, and we tear each other's ideas down, and some ideas don't make it to our portfolio, and that's why. But that is a very, very important question. What is their competitive advantage? So brand name can be a competitive advantage. There's other types of advantages out there. I think Amazon, in the case of Amazon, it has brand recognition. I think that brand obviously has lots of value. But I think there's other things that Amazon has or has done that gives them competitive advantage. For one is their network, their distribution system, their logistics that they invested in. I remember thinking, years ago, Amazon at the time was using UPS and FedEx to deliver a lot of their products. And I said, why? And I kept hearing rumors that Amazon was going to build out their own network system and distribution and logistics business. I thought, why would they spend all that money to do that? Well, now I get it. I didn't get it at first, but absolutely that gives them huge competitive advantages. I went backpacking last week. I needed a battery charger. I was up in the Uintas and mountain range, off the grid. Took my iPhone up there. We got rained on. I watched a little Netflix up there. Got a lot of rain.
10.
But But I realized the night before we were leaving that my battery charger wasn't working, and so at 6 o'clock the night before, I got onto Amazon, and I ordered one, and it was delivered to my home at 4 a.m.
That's crazy.
Before I left, later that hours before I left. It's amazing. So that gives Amazon huge competitive advantages, and I don't see anybody ever catching them. At least I can't see anybody on the horizon right now.
That competitive advantage again helps reduce risk by owning the company, but it also it allows you, and we always say this, although we would never do it. We say, what are the companies that we could close our eyes for 5 years and not be worried about?
I say 10 years.
10 years. Yeah, I'm a fiver. Competitive advantage is huge in that regard.
It's huge. Yeah. What if the stock market closed for tomorrow for 10 years? Look at your portfolio.
But the businesses continued to operate.
But yeah, the stock market closed. So you just couldn't sell it. They became private businesses, and there was no public market to sell your securities. Would you feel comfortable owning the businesses in your portfolio? For me, which I own the same businesses that all of our customers do, the answer to that is absolutely. I actually I would love to be able to look into the future and see where, over the next decade, and some are going to do really, really well, and there might be one or two in there. We don't know. We don't think so, but there might be one or two that don't do as well as we had expected. So, but overall, absolutely, I feel comfortable that. And that's one of the questions we ask ourselves. Do we feel comfortable owning this business over the next 10 years if we couldn't sell it? If we don't answer yes to that question, then we shouldn't buy it in the first place.
Yep. That's number 2, a long-term competitive advantage.
And there's a lot of different competitive advantages businesses can have. We talked about brand, distribution network, low cost.
But it's also in an industry, like I think of Boeing. Boeing's a good example. Because there's only 2 companies that do that, right? And so a competitive advantage could be like that, although the company hasn't been well run. It still has a competitive advantage.
Oh, yeah.
So
yeah, for sure.
The third thing is they have to have excellent management in place. What does that mean?
Yeah, that's just who's running the business. And do you have people running the business that if you're the owner of a business and you are looking at your managers that are running the business that you own, it's logical that you would want good people that you trust, that are smart, that are energetic, running your business. If they're dumb and lazy and dishonest, you don't want those people. So those are the things we're looking for in managers that run the companies we own. Is smart, lots of energy, and they're honest. If they're not honest and have lots of energy, watch out, right?
And the hard part with number 3 is that people interject politics with investing a lot, right?
Oh yeah.
And I, with the help of you, have to slap myself in the face sometimes because I do it too.
Check your politics.
You got to check your politics at the door. What do I mean by that? Reed Hastings, right? Incredible CEO. I don't agree with everything he does politically, but he is an excellent CEO, as shown by the complete pivot that he's done in his business with bringing advertising to the door, right? Good management are good allocators of capital, but they pivot and change when they need to keep the competitive advantages they have or they want in the future. And that's very important.
Very important. I love that you said. I love that you said one of their jobs is to allocate capital. You just mentioned
Yeah.
that. That is probably the most important job that a CEO has, is allocating the capital, the resources of the company, the business, into new investment opportunities in the future. That's what's going to drive the future value of a business, is allocating capital. That's what Warren Buffett does. That's what Reed Hastings is doing. They are allocating the resources, and hopefully they're reinvesting those capital resources in good new investment projects. They're going to get a good return over time, and that's how we're going to see increased profits, increased intrinsic value growth over time, is the decisions that management makes on how to reinvest those capital resources in the future.
Yep. Very important. It's not that you agree with everything that CEO is doing and their views of everything. It's how are they good at running a business?
Are they good at?
That's the important thing.
That's absolutely. I love that you said that. That is the number one question. Are they good capital allocators? Are they good? You may not agree with Reed Hastings' politics, but guess what? Okay, so look at Buffett. Buffett is he's left leaning. He's conservative fiscally, but liberal socially.
Yeah.
His best friend and partner for the last 60, 70 years is Charlie Munger, who is an ultra-conservative. Ultra-conservative. They don't see eye to eye politically,
No.
but they're best friends.
And
they both understand business and how to allocate capital. It's okay. We can agree to disagree, and we don't have to see eye to eye on exactly. But what we do have to see eye to eye is on how they manage the business. Are they allocating capital in a smart, wise way for the shareholders?
Yep, 100%.
And Reed Hastings is, in my opinion.
Yeah, mine too.
Yeah.
And I was a critic going in. Check your politics at the door. Anyway. The fourth thing, which is arguably the hardest, right? And I'll even backtrack. If a company meets those three things, then we keep track of them. And if we really like the business, we keep track of them. And we put them on, on a spreadsheet, an internal spreadsheet. And then we keep track of this fourth thing. And this fourth thing really tells us when to buy. And that is that business, I'm not even going to call it a stock. I'm going to call it a business. That business has to be available at a good price below what the company is worth for us to buy it.
Yeah.
Now, what in the world does that mean?
Yeah. We call the term that we use is it's selling below intrinsic value. Intrinsic value is what is the current value of that business? That is, in other words, that is the intrinsic value, the current value of the business.
So it would be like valuing real estate.
Yeah.
This home's worth $1 million.
It's
just a lot more complex than that.
In real estate, yes, it's a little bit more complex because businesses are valued on future cash flows. Your home is not really a cash flow generating. Right. It actually costs money, but it's on replacement value or alternative or comparables. This is what they use. That's what when you sell your home, they're gonna bring in a guy that estimates that. What do they call those guys?
Appraiser?
An appraiser come in, and he's going to look at comparables like your home and in that area, and to come up with a fair value or intrinsic value of your home. Well, and there's some of that also in the business world too. I mean, for example, in the business world or valuing a business, you may look at comparables. You may look at, for example, Disney and Netflix and how much people are paying per subscriber for Netflix, and you might compare that to Disney, and to come up with an idea of what the business is worth. But ultimately, the way that you value business is you have to look forward and look at future cash flows and and value those cash flows based on lots of things, but interest rates, which is the risk-free rate of return. Not to get too deep in the weeds, but that's part of it. And then you look at comparables, other companies. What are they selling for, and compare it to your current company. But ultimately, the value of a business is if you look forward, and if you were to the value of that business is its future cash flows discounted at a certain discount rate back to the present value. I mean, that's technically how you value a business.
We could probably do a 2-hour class, probably 8-hour class, 20 on how we would value a business. But that's a good summary.
But that's the appropriate way to value a business. Anybody that's going to value a business, you're going to want to know what do those future cash flows look like, say, over the next 10 years. And
each business is different as to how to value it,
and
based on the industry,
right,
and the business as a whole.
Right, and the growth of those cash flows is part of the calculation of the value.
Yeah.
So if you have a company that's growing cash flows at 20% a year versus a company growing cash flows at 10% a year, well, that company at growing cash flows at 20% a year is going to sell at a higher multiple than one at 10% a year. That's pretty logical. And so you have to take all those things into consideration.
So and I'm going to go back to real estate because that seems to be what people understand. If a home is selling for $1 million, right? It's worth $1 million. Applying our philosophy as to when we would buy that, what would it need to be selling at?
That's a great question. So when we buy a business, we want to buy with a margin of safety. So
which would be what?
Yeah. Well,
what does that mean?
Our margin of safety is a 20% discount to fair value or intrinsic value. Yeah. So if the business is worth, say, $100 a share, we look at all, do estimates on future cash flows and the likelihood of those cash flows and the growth of those cash flows and, all those things, and come up with a fair value or intrinsic value of a business, say $100 a share. That means that when the stock is selling at $80 or less, that is in our buy range. That's when we are actively buying that business. When a business sells at 90% of intrinsic value, we don't get really excited about it. We might buy a little bit of the company, but we get excited and we'll take a full allocation of a business when the stock is selling at least a 20% discount to intrinsic value.
So if that $1 million home selling for $800,000, we're interested.
Yeah, then
we're going to buy.
We're going to make an offer. Yeah.
So right now, and if people and some of our clients have seen it, we have this spreadsheet, and it just is color coded, right? And the green means the companies that we love are selling for 20% below what they're worth. Probably a month ago, of the 40 stocks that we love that meet the first 3 criteria, about a month ago, half of that list was in the green. Mm-hmm. And that's because the market sold off. The market has rallied since, and right now there's 5 in the green. So it's changing all the time, and that's what we love about the stock market is the volatility of the stock market provides opportunities to buy businesses for 20% off. Is essentially how I look at it.
That's right. That's the beauty of the stock market is fear and emotion often
lead to opportunities.
Yeah. And when you're negotiating with a rational owner of, say, a piece of property, and you're a rational owner or a rational buyer, and it's a negotiated transaction, probably nobody's going to get a great deal.
Yeah, not unless one side is completely desperate.
If I'm this guy, like, I got to have your piece of property. I don't care what what you say or what price you throw at me. I'm going to buy it. Then
that's not rational.
That's not rational, and you're going to benefit, and I'm going to be the one that overpaid for that business. That's what happens. That can happen in the stock market. Stocks can sell above fair value, and stocks can sell significantly below fair value. That's what makes investing in the stock market, investing in companies that trade on the stock market, so difficult and challenging because you get a price every single day, and that sometimes scares people.
Well, provides opportunities as we look at it.
Provides great opportunities.
So let me wrap this up and go right back to where we started, which is how most firms do it, which is invest overnight so they can go and gather more assets. How do we do it? Well, we look at our list of companies that we love, and when they're on sale, we buy. And if they're not, we wait. And sometimes we wait a couple days, and sometimes we wait a month. We don't know, but that's why, again, going back to what you said, that's how I'd want my money invested.
That's why we do it this way.
When a business is on sale, I want to own it. I don't want to buy at a premium.
That's why we do it this way. Which I 100% agree. Are we perfect in doing this?
Oh, no.
No, we're not.
No.
But we think that if we add all of these 4 different processes to our approach, which we do, we think that we reduce, and then this is the reason why we mentioned this earlier, we reduce the probability of permanent loss of capital, and that ultimately that's what we want to avoid that.
So if we're reducing the probability of the permanent loss of capital, we're increasing the probability of making money.
Exactly.
And we're not perfect, and there's no guarantees, but that's the process.
And it's hard.
It is.
Let me just say, it is really hard. This approach is not the easiest, and it's challenging, yep. And we do the best we can. And I absolutely believe in the process, but we're not perfect, and sometimes we do
perfect. There's a lot of late night studying, as indicated by the case of Monsters by that Diet Coke you mentioned. But we work our tails off for our clients, as we would want if we hired somebody.
Yeah.
So that's our portfolio philosophy. That's how we invest. I hope that sheds light. If you've heard, no doubt you've heard, if you've been listening to the podcast, those 4 principles scattered throughout our podcast. But that's how we invest. That's our core philosophy. Amen, brother.
Sometime.
Anything else?
We should maybe next time we talk about how you look at options.
Yeah, we should.
That's your expertise.
Which is tied back in to the same philosophy, especially number 4. Which we should do that.
We should do that next time.
That's a great idea. That's why you're the chairman. Because the chairman is the man.
Let's do it.
Anyway, thanks for listening today. Until next time. Bye-bye.